Hello, Business 630 students. This is Professor Hassey. This is my week one video for Friday, October 29th, 2021. This is our first week, and I know you're all getting familiar to our course and familiar to my style. And my style is this. I produce 2 videos a week for the 8 weeks of our course. The first video is posted every Monday at the beginning of our course week, where I talk about the key topics and lecture about the topics for the week. Then I have another video on Fridays, which explains any case studies that we're doing, which we don't have now. We don't have any case studies until week 3, but just to explain any formulas or any follow-up to my lecture of the week. So this is our week 1 Friday video. And since we don't have really much material to talk about this week, I'm going to go over a couple of things, do a couple of formula definitions, which you all should know from our chapter 6, and then end it, heading into our week number 2, which begins this coming Sunday. So first of all, I want to wish you all a happy Halloween weekend, and I hope you'll be safe this weekend. And also to, again, welcome you to our class. I had about 6 students attend our student hours on Thursday evening last night, and a lot of them had questions about the issues I'm going to be dealing with today. So please feel free in the future to come to those if you have questions or getting a little bit behind or don't understand. I have student hours every Thursday evening via Zoom from 6 to 8 p.m. And the link is in Blackboard, the link is in your syllabus, so please take advantage of that. Last night we had some students come on, and I think it proved of some value for them. At this point in time, you should probably be getting familiar with or have looked over some of our Blackboard files, and also our course syllabus. And I just want to go over a couple of more things to make sure that you're aware of these and will know how to use them. First of all, as I just mentioned, we have student hours every Thursday evening. Here is the Zoom link for that meeting. You just click on it and you're automatically in. Now, sometimes when you come into the Zoom meeting on Thursday nights, I might already be with some students. So you'll be put into a waiting room, waiting for me to get freed up, and then you'll come into the Zoom meeting. So just to know that, to just be patient. I know you're there because I get a little text message from Zoom saying you have people in your waiting room, so I'm aware of that. So please just bear in mind that when you come on and where's Mr. Hassey, what's going on? It's because I'm probably with some other students, okay? So again, Thursday night is a good time to get in touch with me. All right. Another area of importance is our YouTube channel. The YouTube channel that we have for this class, where you can access videos for this Fall 2 Business 630 class. So use that link and there'll be videos, our class recordings, our lecture recordings. I'm recording this Friday video, which will be posted to YouTube and Blackboard. So if you can watch them at your leisure. Another important part of this is naturally our textbook, but it's optional, but I will be using this textbook, the 16th edition of Financial Management Theory and Practice. We have 4 case studies in our class, each worth 20%. And then we have a case paper, which is a paper and a spreadsheet analysis. And we will begin discussing that case paper next week. Again, the case paper is individual. It originally was planned in this class to be a group case, but it's individual. So all 5 assessments in this class, the 4 case studies and the case paper, are all individual work. So just so people are aware of that. Here are some important dates that you should be familiar with. You should make a copy of this, keep it handy in a notebook, keep it handy on your desktop where you do your schoolwork. Please keep this handy. It's the key dates when specific assignments are due in our class. And notice our 4 case studies are in a variety of different formats. I discussed this last night in our student hours. The first case study, which will be during week 3 of our class, so it's still 2 weeks away, due November 14th, is an APA format paper. We'll be talking about chapters 6. We'll be talking about chapters 4 and 5 in that case study. So, all right. Then our next case paper is 2 weeks later, is case number 2, which will be a spreadsheet format only. You are to do a spreadsheet, not a PDF, not a Word doc, a spreadsheet of a capital budget analysis. Many of you have done this before in prior classes, but this is going to give us more practice on this. Then we have case number 3, which is a PowerPoint format where you produce a PowerPoint like you're giving a presentation, but you don't have to give the presentation. You just give me that PowerPoint file and I will assess it based on the topics of case number 3. And finally, case number 4, which is due the last Sunday of class, December 19th, which is also an APA format, looking at the final few chapters of our work. Your case assessment paper, which is due also on that Sunday, December 19th, but you'll be given that work or that task next week. Doesn't mean you can do it all the time next week, but I'll be giving you that work next week, but you have 6 weeks to do it, plenty of time. And that case and that course assessment case is in 2 formats, an APA or Word format file and a spreadsheet format. So there's 2 files with that case. If all goes well, you do your course evaluations for this course, and then you'll get your final course grade, ho, 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 Merry Christmas, on Thursday, December 23rd. So those are the key dates for your grading for your work in this class. So please stick those into your iPhone calendar or your Google phone or your Samsung phone and have those in your calendar so you know when those dates are due. And again, here's our course schedule, which hopefully you've looked over. I've modified it a little bit. I had a very good question in the student hours this past week about, are we supposed to read all these articles that we see in these weeks? For example, in week 2, next week, I have a couple of articles or a couple of links there. I will point out that to you in my lecture video at the beginning of the week, which articles, which things you need to do. Sometimes I adapt or modify this course plan during the course of our course. You do have 1 article to read this week, as I mentioned in our lecture video. It's the N.A. Nichols article from the Harvard Business Review. I need you to read that for this week. And so yes, I will give you remember at the beginning of every week, I do a week agenda of things we need to do. So that agenda was at the beginning of this video today. So, and it's also posted in week 1. Look that over. It gives you the highlights of the week of which you need to do. There's no graded work this week. Your only work this week is to do the course student discussion forum, and I'll get to that in just a minute. So those are a couple key things about our course. There's our schedule. There's our important dates. And just to make sure you're up to speed and know where all the links are and what makes up our course syllabus. Very important. And then in addition to the course syllabus and the schedule, make sure you're up to speed on the Blackboard, on where to look for, where to go to things. Whenever I send you an email, it's also posted to the course announcements. So you can make sure you go to course announcements when you sign on to Blackboard. Remember, Blackboard is part of your course grade. It's part of your class participation. It's part of my assessments of your casework. If I see students who don't attend or go to Blackboard very much, I'm going to be questioning their ability to do some of our casework. So make sure you go to Blackboard multiple times during the course of the week to see and to review our material. Whenever I post a video and give you links, here's the links to here's this week's lecture video. You can play it right here in your Blackboard, or you can just follow the link to our YouTube and you can watch the video. There's our welcome video. This video will be posted to this link also as soon as I conclude. Very important. We have the student discussion forum where you post, for example, this week, I'm asking you to do a biography. I'm asking you to pick a company to follow during the course of our class. At the same time, I want you to find the beta of that company. Now, the method of that madness will be described in just a few minutes by this PowerPoint. I'm going to go over explaining that. The main thing about this is I want to get to know you as quickly as possible. I want to set the class up so it proves you of some interest. I look at what you're doing for a job, what's your background, where are you from and what part of the country. That's very important to me, and it gets me an idea of how to create the class, make it interesting for you, and give you all some value in this very short time span we have together. And also, you're selecting a company which you're going to track and do a lot of work in your case studies over the course of this session. If you have questions of me and you don't want to wait for a Zoom session, you can just post it to this question and comments that is available every week. Post a question there, and then I will respond to you right away. So this is another way of keeping in touch with me and asking questions. And then if you go week by week, like for example, here's the file I'm going to go over tonight, this PowerPoint for my Friday PowerPoint. There's my lecture video. There's the article I would like you to read for this week, which we will discuss in next week's lecture video, and then some other videos, and there's our agenda, and so on. So every week is set up like this. So if you stay on top of this, keep track of what's there, you review it, you study it, you watch it, you'll be in great shape for our case studies. Well, as I said, every week I do 2 videos. The first video is an introduction and then talking about the topics of the week, which is posted every Monday. The second video is on Friday, which kind of highlights the week, goes over some key points. And if you're doing any case studies that week, it's giving you some backup and some help with the case study. So this week, there's no graded work besides just picking a company, so I don't have to spend much time on that. But I want to introduce our course to you this week. I want to get you to be familiar with what we're going to be trying to do and up to speed on that. Again, this PowerPoint is located in week 1 under my Friday PowerPoint. You can watch it at your leisure, but I want to go over a couple key points of this. First of all, the definition of corporate finance. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision-making if the corporation is to maximize profits and stay competitive for future success. Boy, if that's not an MBA answer, I don't know what is. But let's make sure we understand this. What is a capital budget? A capital budget is putting together an analysis of an investment in an asset and what return that asset will give over a period of time. And as you all know from accounting, the length of an asset in business is its depreciable life. The depreciable life of the asset is its life. And a capital budget is verifying or doing an analysis of whether that investment in that asset is going to provide an adequate return to your company and, more importantly, to your investors. Remember, the definition of finance is to maximize value of the company, to increase the wealth of the company. Just today, Microsoft became the richest company in the world in market capitalization. Almost $3 trillion Microsoft is worth today. That's somebody's doing their job at Microsoft. They're maximizing the value to the investors because Microsoft is worth $3 trillion. Amazing. What is capital structure? Well, capital structure, very simply for you accountants in the audience, is the right-hand side of the balance sheet. It's how you fund the assets of a company. There are 3 legal ways to fund assets. Debt, both either short-term or long-term debt, which is interest-bearing. 2, equity, the issuance of public or private stockholders. And 3, profits. Most companies like to use profits to finance their assets because why? It's cheap. They don't have to pay interest. They don't have to pay back the principal. They don't have to pay dividends. They're not charged with having maximized returns to their shareholders. Profits are nice. It's just that at some point during the company's life, they're not going to be making much profits due to competition, due to the economy, due to their own failures. So these three things are what make up capital structure: debt, equity, profits. And working capital. What is working capital? Well, working capital is the day-to-day management of your business. You purchase an asset. Assets usually have lives from 3 to 30 years. That's long-term. Working capital is the management of your receivables. Working capital is the management of your accounts payable. Working capital is the management of your inventory. Working capital is the management of short-term debt. Working capital, most importantly, is the management of your cash flow. It's short-term operations. Do you have enough cash to pay your bills? Do you have enough cash to invest long-term? That's what working capital is. So the effective management of capital budgeting, capital structure, and working capital is what this course is all about. That's corporate finance. There's three principles by which this is driven. The investment principle. The investment principle means you want to earn enough money off your investment that exceeds the cost, what it took to invest in that investment. And that's sometimes called the cost of capital, or also called the hurdle rate. If money is costing me 7% and I invest that money in an asset and the asset only returns 5%, I'm not doing a very good job. Either I have to find cheaper money or I got to invest in an asset that's going to have higher growth. Welcome to the world of corporate financial management. The financing decision is number 2. Where am I going to get the money to invest in the asset? Debt, equity. What is that mix of debt? Remember, debt is you have to pay it back with interest. Interest, yes, is tax deductible, but you can pay it back. Equity, though, is ownership. You don't pay back ownership. Ownership is there always, and you have to keep your shareholders happy. Sometimes it's better to borrow money than it is to issue stock. It's a lot easier on the management team of a company because there you have to pay it back and then it's done with. Shareholders are always there. That's why so many companies in these modern times, I'll say post-2000, buy back a lot of stock because they want to reduce the number of shareholders who make their lives very miserable. And then finally, it's the dividend decision. How do you get the money back to your investors? Dividends, interest, and how much do you give back to your investors? Sometimes you might want to keep that money to reinvest back into the company. What's this dividend decision strategy of giving an adequate return to your investors? I think of the key formula or the key aspect of Chapter 6 that I want you to get a handle of. And again, many of you probably already know this, but I wanted to go over it. It's called the capital asset pricing model. Remember, the topic of Chapter 6 is risk and return. All right, risk and return. Is it worth the risk to get the money as a return? And what is that risk? Well, the risk, as we talk about, is called beta. That's the measurement of risk. Beta. It's a statistical standard deviation analysis, and we don't have to worry about how to do that. You study that maybe in statistics. But the beta of a company is its risk relative to the other market indicators. And what is called in this capital asset pricing model is called a security market line, where you can determine the required return on a stock based on the stock's risk in the market relative to the other factors in the market. And that's what I'm talking about in this slide. I'm going to be looking at what should I expect from investing in Apple Computer today. All right. An Apple Computer today currently has a beta of where's their beta? 1.22. Remember, in the market, beta is a comparison to the averages or the standard deviation from those averages of market. A beta of 0 is risk-free. That's the United States Treasuries. There are 2 organizations in the world that have 0 risk as far as their investments are concerned, meaning you're not going to ever lose your money. The government of the United States and the government of China. If you buy a Chinese note, a United States bond, you're going to get paid. No ifs, ands, or buts. 0 risk. Why? They're the largest economies in the world. And if they don't have the money right then and there, they can just print it without any questions asked. The second key beta number is a beta of 1. That's the market rate of return. That's the average market return in the stock market for the last 4 to 5 years. All right. Right now, the average market return in the stock market is 10%. If you invest in an ETF that's invested in the Standard & Poor's 500, if you invest in the market, you're getting a rate now of about a 10% return on your investment. That includes dividends too. So that's the market rate of return. And then you have the beta of your own individual company that we're looking at. Right now, if any of you picked Apple, if you went to Yahoo Finance and looked up the beta of Apple currently, today as October 29th, you'll see that the beta for Apple right now is 1.22, meaning that the risk in the market of Apple investment is a little bit higher than the market return average of 10% or 1.00. So it's a little bit more riskier. And that doesn't mean that Apple's a bad investment, far from it. It just means that there's a little bit more deviation in the error that you might get paid or not, right? With a beta of 0, there's no deviation. You're going to get your return no matter what. If I invest in a 10-year United States Treasury, I'll get about 1.62% on that money every year. That's guaranteed, no risk at all, no margin of error. If I invest in the United States stock market, I'll get a return of 10%, but that has a little bit of a deviation. I might not get 10%. I might get 9%. I might get 11%. And that deviation from the average is what that beta represents of 1.0. It's average deviation, I guess you could say. I don't want to get into too many statistical numbers here because it just gets you all, we don't need to bother about that. Where Apple, if you take a look at Apple's return, they have a little bit higher deviation. In other words, they earn good money, but it's not consistent. It changes from quarter to quarter. And that's why they have a beta of 1.22. So if I called up my stockbroker today and said, I'm thinking about buying Apple stock on Monday morning, what do you expect the return on that Apple stock is? Well, your broker might say, well, let's look at the capital asset pricing model. Right now, the capital asset pricing says the required return on stock is equal to the risk-free rate in the market plus the market risk premium times the beta of that particular stock, in this case, Apple. What is the market risk premium? The market risk premium is defined as the market rate of return minus the risk-free rate. And this is all talked about in chapter 6, but if you read it, you go, what the hell are they talking about? So hopefully this will make this a little bit easier to understand. So right now, what's the market risk premium? The market rate of return for the S&P 500 currently is 10%. The current risk-free rate. Now, what's the risk-free rate? The 10-year United States Treasury return on investment. And that's currently 1.62. So the market premium today is 8.38%. So if I apply that to that security market line required rate of return formula, Apple's expected return is the 1.62% risk-free rate plus 8.38% market risk premium times the beta of Apple 1.22. That equals 1.62 plus 10.22%, which means that right now I should expect in the next 12 months an expected return on my Apple stock in relationship to its risk in the market of 11.84%. Okay, Now, if I don't think I can get 11.84% in the next 12 months on Apple, based on their projections, based on my feeling about how the company is being managed, then I won't buy Apple stock on Monday. But if I think I can buy Apple stock at $130 a share and get that 11.84% in the next 12 months, I'll put in an order. Another name for this expected rate of return is the cost of equity. Apple Computer up in Palo Alto and San Jose today knows that the typical investor in the market, taking a look at the risk in the market, is going to expect around 11.84% return in the next 12 months in Apple. So it's the financial management of Apple to make sure they get that return. In many cases they do. That's why Apple stock keeps going up. But when they don't, that's when Apple stock goes down. So that's one of the key things, or is the key thing from chapter 6, is this understanding of how we can equate the risk in the market for zero risk, the risk-free rate, average risk, market rate, and the particular company's risk, in this case 1.22, and how that equates to a percentage. Remember this, we're going to be using it a lot. And part of the way of determining maximizing value is understanding the relationship of the cash flow, the profits, and the investments that return off a company projected out into the future in relationship to the cost of money it took to get that cash flow. That's called the weighted average cost of capital, or it's called also the hurdle rate. And the hurdle rate, or the cost of capital, is a combination of debt and equity. In the example we just used in the capital asset pricing model, that's a way of determining the cost of equity. The cost of debt would be what a company is paying on their debt to bankers, to bondholders, and the like. The combination of that cost in relationship to the cash flow being generated determines the company's value. Many times you hear in investments, you should buy the stock, it is undervalued. In other words, based on the returns and the cash flow being generated off the company in relationship to their cost of money, the stock price in the market is lower than what the value of the company really is. That's why if it's undervalued, many investors say, I'm going to buy it, because you're getting the stock cheap in relationship to its potential true value in the market. We'll talk more about this as we get going. The definition of free cash flow, we'll talk more about this when we get to our chapter 3 work, is the cash flow being generated off the investments of the company and the profits, and those cash flows are used to pay off third-party investors in the business. We talked about WACC, the relationship of cost of equity and cost of debt, the capital structure of a company. And here's something that's very important for anybody in corporate finance, is to take a look at key financial indicators of finance and what it tells us about the economy and the markets we're working in. And these key financial indicators here are as of October 26th. All right, this past week, there's roughly here 3, 6, 9 indicators that everybody in finance should be aware of. Some of them relate to the topic we just talked about. The top 3 are the Dow, the S&P 500, and the Nasdaq. Those are the 3 leading indicators of equity markets in the United States. The Dow Jones Industrial Index is the top 30 companies in America as chosen by the Wall Street Journal. The Standard & Poor's 500 is a listing of 500 companies that they deem represent the United States economy by the company Standard & Poor's. Who's Standard & Poor's? They're one of the leading credit review agencies of the market. They do the FICO scores for companies. And then there's the Nasdaq Index, which is another index of stocks, more small and mid-sized companies. And there's 2,500 companies listed in that Nasdaq Index. Notice how the Dow has gone up since December 31st of last year. Pretty impressive, huh? Makes you want to invest in stocks a little bit more. The stock market has been going great guns. Even in a pandemic, even with inflation fears, the markets are still doing very well. The next indicator is the state of the credit markets, the debt markets in America. Remember I talked about the risk-free rate? This is the risk-free rate. The 10-year United States Treasury yield, if you give today, if you go to Wells Fargo and go to your banker and say, I'd like to buy a 10-year United States Treasury note, you give them $1,000 and they'll give you a note for $1,000. And that note will be paid back to you in 10 years, $1,000. In the meantime, in every year from year 1 to year 10, you will be getting 1.618% return on that $10,000 as money deposited into your bank account. What does that mean? Not much money. It means you'll be getting $16.20 every year in interest on that $1,000. Why so low? Because that's why it's the risk-free rate. There's no risk involved. So the government doesn't have to pay you a lot for your money because it's guaranteed. There's no risk in that money, thus it has the lower interest rates. But notice a key indicator here. Look at December 31st. It was below 1%. Now it's over 1.6% in 10 months. What does that mean? Inflation. Money is becoming more expensive. Here in Southern California, the current inflation rate for 12 months is 5%. That's got a lot of people scared, including especially the Federal Reserve. High interest means high cost. The company's reducing profits. So that's something to watch in the market. The next two indicators are commodity indicators, the two biggest ones, oil and gold. Notice oil. Oil has almost doubled in this year, meaning the price of oil is going up. We see that at our gas stations, at the gas prices. Also, our oil companies are doing a lot better than they did a year ago as far as profits are concerned. Oil, even though we're using less of it in America, is still the leading commodity to watch in the world. It generates a lot of profits and a lot of expenses for a lot of entities. And then there's gold. Gold is a leading indicator because it's called a hedge. When people think the stock market is going to go down, they buy gold. When they think interest rates are going up, they buy gold. Notice gold is down this year. Why? Because the stock markets are doing well. Why should I pull my money out of the stock market when I'm earning 10, 15, 20% and gold is losing? Professor Hasse is an investor in gold, and I haven't done very good this year. But I'm betting that with inflation coming into 2022, that those gold prices will be going up due to inflation. And then the last three indicators are very important because we are now in a global economy. You have a business in San Dimas. That business is doing business with companies in Mexico, Europe, Asia. So we have a world economy, and understanding the relationship of all the currencies in the world is very important. The three leading indicators of currency, the euro, Chinese yuan, and the Japanese yen, and how those change and react in an economic cycle is very important. We'll talk more about that down the road in this class. So every morning I wake up at 5:30 in the morning. Even though I'm not working, I still get up at 5:30 in the morning. And after I get the morning paper, feed the cat, get my wife her coffee, the next thing I do is read the Wall Street Journal or turn on the business channels, and I look for these 9 indicators. They tell me how my investments are doing. If I was running a business, it tells me how my business is doing in regards to debt, issuing new or getting new, borrowing more money, or issuing stock, or doing business in a foreign country and the currency exchange. These 9 indicators are huge. Anybody who's a study of finance, anybody who's an MBA degree and going to be in financial management should daily watch these numbers. It helps. The Franklin, the Chinese yuan, the euro. These are the currencies that drive the world economy. and a knowledge of those currencies and a knowledge of how they interact with our financial management strategies is what this course is all about. So your job in this course is to get up to speed on financial affairs. We're going to be studying financial statements. We're going to be studying financial strategies like mergers and acquisitions. We're going to be studying investment returns in the form of capital budget analysis. Our drive of this course over the next 8 weeks is to make sure you're prepared with an MBA degree to go out and look at certain financial and business strategies, make strategies in changing markets to adapt your specific business with its specific risk to maximize the value of your company. That's why companies are going to pay you the big bucks. With an MBA degree, you should be able to do that. And we're going to present those strategies in different formats. That's what the case studies are all about. The case studies are all about making sure you can write, present, calculate. APA format, spreadsheets, PowerPoints. If you're being paid the big bucks with an MBA degree, you should be able to be a communicator. I can't tell you how many times I have been in meetings with companies, with people, with organizations. People are being paid a lot of money and they don't know what the hell or how to communicate. They don't know how to explain things. They don't know how to explain it to their workers, their colleagues, their investors. They're smart, but they can't communicate. You need to be able to communicate, and we'll practice different ways of doing that in this course. It's complicated a little bit by we're being online. That puts the emphasis on you, the student, to make sure that you stay up to date with what I put out there, articles, videos, postings, interpret them, and apply them to the case studies when we start having. We will be having, again, review sessions on Thursday nights if students have questions. Towards the end of the class, we'll be having a Saturday review session for the case paper to help you achieve all this. So don't feel that you're alone out there in the internet space, hiding in the darkness of the internet when I talk into the camera like I'm doing now. You have somebody here who will listen, who's there to help you. Please remember that as we go forward. So have a great Halloween weekend. I look forward to working with you every week, twice a week via video, and every day if need be, in any questions or discussions that you have. And so from Claremont, California, in my little hideaway online office here in Claremont, and a beautiful day this Friday, I should be on the golf course, but oh well. I wish you all a great time this weekend, and I'll see you back online next Monday. Adios, everybody. Take care.